Hi, everybody. I'm Brian Pate from the Pate Realty Group and Brian Pate Seminars, and we're coming to you this week with one of my good friends in the real estate business. This is Michael Martin from the Martin Mortgage Group at Fairway Independent Mortgage Company. Did I get that right, Mikey?
For the most part, corporation instead of company, but yeah, that's great.
Okay, close enough. So Michael and I have known each other for a little over 10 years at this point. He's been one of my preferred lenders for a long time. And so in order to keep up with what's going on, I know a lot of the times people hear me talk about what's going on in the marketplace. So this is just a continuing piece where we talk to other professionals in the marketplace to find out what's going on from a business standpoint for both buyers and sellers. So Michael, I know we were talking earlier. We had lunch last week. By the way, thanks for lunch. It was an awesome experience again, as always. And thank you for the promotion on your Instagram account. By the way, we'll share that Instagram information with Michael. He's got a great social media presence that's really full of information for folks. So I encourage you to follow him on that. So, Michael, talk a little bit about what we were discussing previously with where interest rates are from 2018 compared to 2022 to compared to where we are now.
Yeah, so preparing for this, you kind of shared with me, you'd like to just make sure we understand exactly where interest rates are today. Somewhere in the neighborhood of 6.5, give or take, depending on whether you're paying a point or not, and obviously depending on your down payment and your credit score, all those kinds of things and the type of loan, right? So somewhere in the mid sixes, let's call it. Um,
Okay.
as I was looking at a couple different things, it seems like, we've been spoiled and blessed with super low interest rates for a long time. We all know that. But I feel like a lot of us, I'll tell you, me specifically, felt like 2020 and 2021 and half of 2022 were were really right. Obviously, the lowest we've ever seen, at least in my career, I think probably ever. And so we were blessed with an amazing opportunity, whether it was refinancing clients or helping them purchase homes at super, super low interest rates, which gave them a lot more buying power. I don't think people understood that completely. I can tell you as a mortgage pro or expert for 20 some years, I don't know that I think I would have bought a lot more real estate back in 2020 had I really kind of put that together. So I'll be prepared for the next time we have a
Well,
new
and I would say that some of those rates probably propped up artificially inflated home prices, where if the rates had maintained in the fives or the sixes, we'd have never seen 18 to 22% appreciation rate
appreciation.
in our area at
Yeah,
least.
of course. Yeah, no doubt about it. We did have a lot of people moving here, but that being said, it certainly wasn't that kind of appreciation. There was a lot of people fighting for homes. So
Agreed.
you and I were discussing, and I'm going to share my screen if you don't mind, sir. Let me
Go ahead.
know if you see this. Um, this is a good tool just to get an idea of kind of where interest rates are. I don't know if you guys ever use Mortgage News Daily. Though you can actually sign up and get an email each day that'll kind of give you an idea of where rates are. But this specifically is a chart that goes back. I actually just put in January 1, 2002, because I started at the very beginning of January 2002 to see where rates have come in my 22, almost 23-year career. So when I first started, rates were right at 7%, right? Interestingly enough, where they've been kind of hanging out for a while here recently, until they move back down. But and really, like, this one kind of surprised me. Rates really had been under 5%, with the exception of like a very small window where they popped over 5% in November of 2018. And really had been again below 5% all the way until you go back to 2011. And so we have been extremely spoiled, right, with low interest rates until, since the May or April of 2022 is when rates started spiking. And you can see the massive spike there, right? Like where we were in December, and then what happened, obviously, in the beginning part of 2022.
So in
And
there,
so
just for clarity here, for those watching, we're talking about more than doubling of interest rates in a matter of about 90 to 120 days here, and it's actually almost 115 to 120% of what it was back in December of 22 and January of 22 when you look at it in May or June of that year.
Yeah, when you look at, the low, right, was somewhere in the neighborhood. Well, I guess the all-time low was somewhere right here at the end of December 2020. Still remained very, very low into August of 2021. But then, almost three times when it actually got to its peak, close to 8%, last October.
Mhm.
So naturally, that is gonna hurt the buying power, you know, of what people are gonna be purchasing. I'm gonna take one more peek real quickly here for you as well. Let's go back and see maybe a 2 year span. This is I know you're very well aware of what this information is. This is mortgage-backed securities that are traded on Wall Street every day. This is what controls interest rates more so than the Fed. The Fed influences, but this is actually what controls interest rates. As you look at bond pricing going higher, interest rates go lower. As bond pricing goes lower, interest rates go higher. So when you go look even here at the last 3 months, and this is, I think, one of the things you wanted to make sure we talk about today, Brian, is the Fed lowered rates. So great, interest rates are lower now. Well, actually not, right? You can go back to here. Here's the day. September 18th, right, is when the Fed came out and announced that the Fed will be lowering the Fed funds rate by 50 basis points, which was great news. But the reality is we had been getting lower rates for quite a bit longer. In fact, let's go back a year. Really, you can say all the way back to April of this year is when interest rates have been, getting better. Bond pricing was going up, interest rates were going down, and then all of a sudden we've had this, jump from around 6% to about 6.5-ish, 6 and 5/8, something like that. Now the question is, where are we going to go from here? And there's a lot to determine of whether, where that, what's going to make that happen, right? Ultimately, it's about
You don't have a crystal
inflation.
ball on your desk to just tell us what's going to happen in the next 6 months?
Yeah, I learned a long time ago. People ask me about, what's going to happen with interest rates, and I tell them very consistently, what I know for sure, is that interest rates are either going to go up or they're going to go down. Rarely are they ever going to stay the same.
There you go.
And so, the facts are currently we've taken a little bit of a jump back up to 6.5%. I think there are a lot of us in the mortgage business, certainly people on the real estate side as well, that were very hopeful for lower interest rates. We could, refinance these clients that we've been, doing loans for the last 2 years that there are higher interest rates, get them, into lower payments. They were all expecting that when they bought their homes,
Mhm.
and it hasn't quite happened as fast as they would like.
So let me ask you this, Michael. If we're talking to a first-time home buyer that's saying, I want to wait for rates to go down, and we look at the median sales price of homes in the Triangle market since January 1 of this year, median home price is only up 1 to 1.25%, depending on what particular area you look in. Now, there are pockets that are higher than that, but all across the board, if you look at it, it's right at 1 to 1.25%. Is there validity for those people that have been waiting for the last 6 months and now rates have dropped? Because we were talking 7.5 a year ago when we last did this. And so we're talking about a 1% rate reduction from where we were. So those folks that have been waiting, it's a good time to go, based on what I'm hearing you say,
Yeah,
because the bond market isn't suddenly going to start going skyrocketing here. In my opinion, it's generally a slow roll when it does do something. And with interest rates at 6.5, again, you're talking about maybe points to get down to a little bit lower. And then you've got builders that are doing these massive buy downs, $25,000 buy downs. Now, the buyer's paying for that in the sale price of the home, because when the builder's buying down the rate by 10 grand, they're willing to pay that rate to their mortgage company, but they're bumping the price by 10 grand in order to do that. So for someone that's looking at a resale home that's not going to get that new construction bump, what's the best path for them? Because we know, I think you would agree with me if I said I don't anticipate ever seeing rates sub 4 again unless there's something major that happens that is a complete surprise. I think the Fed learned its lesson being that low for that long, and probably regrets not raising rates a little bit at some point, with instead of dropping it to zero at COVID, when all the pandemic stuff started between March of 2020 and May of 2020. So if I've got a first time buyer that I'm working with, and you could speak directly to that first time buyer, what's your advice as a mortgage lender these days?
One of the things that seems to not be utilized nearly enough, and I've been having conversations recently with clients about this, right? Houses are sitting on the market longer, right? I think you told me the other day. Is it 50,
31% longer. Yep.
but is it like 50 some days or something?
Yeah, the average time on the market in Raleigh right now is 61 days, median's 43 days.
There is no seller that is ever going to list their house and think their house is going to sit on the market for that long right now,
Right,
right? They don't
right,
think that's going to happen. So
right.
when it sits on the market, what do? Well, they will capitulate, right? They will drop their price at some point, or they'll consider a lower offer than their list price if they really want to sell. And so the best way to do that, right, is a two like some sort of temporary buy down, which makes a huge impact. Like I was just talking with a client 2 days ago, and we were looking at they were actually in the upper price points. It's not their first home; they're buying the second home, but it was a price point somewhere around $800,000, and they were
Okay,
going to put 20% down, and it'd end up saving them over $800 a month if they were to do a 2-1 buy down. The cost was about $17,000. Now, think about a price range of 800 some thousand dollar price, right? If you're going to do a price drop, it's not going to be $5,000. Not if you're going to get anybody's attention. It's going
right.
to be $25,000. Well, if you drop the price by $20,000 for the buyer that's going to buy that property, it moves their mortgage payment minimally, right? But if you utilize that same money towards a temporary buy down, and a temporary buy down, just so everybody understands, let's say rates are 6.5 today. If you do a 2-1 buy down, and we have multiple options. There's a 3-2-1, a 2-1, a 1-0. But a 2-1 buy down is probably the most utilized. And a 2-1 buy down says you're going to make a mortgage payment equal to, instead of 6.5, 4.5%. Your note rate is still 6.5, okay? But you're going
Okay,
to make a mortgage payment equal to 4.5%. And that, in this case, dropped the payment over $800 per month,
right.
right? Now, that makes a significant difference for that buyer.
Sure.
And so I think that's a great opportunity. We've helped a few buyers that didn't know about this, and even some real estate agents that didn't understand how to utilize this program recently get under contract using it. And the seller was thrilled to do that, to offer that concession versus dropping the price, especially on the new construction side. That's why you see so many builders that have to do that. They can't drop their price because if a new construction, right, in a new neighborhood drops their price, then it changes the comparable sales for all the other
For
houses
all
in the
the other
neighborhood, and
properties.
that
Right.
that hurts them in the future.
So let me make sure I heard correctly, because you know me, I'm a numbers guy. You said $17,000 to buy the rate down, and it lowered the mortgage payment by $800 on the principal and interest. That means it's only 21 and a quarter months to make up that difference of that $17,000 that went into it. So even if you paid cash for it, and didn't get the assistance, you're making your money back before the end of the second year by doing that, and you're getting that buy down rate for that length, correct?
That's correct. So you can see the screen, right?
Yep.
All right. I was being conservative because I couldn't remember the numbers exactly. So $750,000 loan amount, 6.5% note rate actually costs $17,070. It's
Okay.
going to save the buyer $940 for the first year. The second year, it goes up so from 5.5% to six. I'm sorry, from 4.5% to 5.5% payment, which is $482. It's going to save them. How we get this cost, by the way, is literally taking this savings, multiply it times 12 months for the first year. The second year savings, multiply that times 12 months for the first year, add those together, and it comes to this number, right?
Right.
And so what happens is the seller basically funds a subsidy to the buyer for their payment for 2 years.
Right.
We can't utilize this for qualifying. Really important to know. Like we're not going to put a buyer in a home that they can't qualify when the payment gets to the top. That's really
Sure.
important, right? We're not doing what happened in subprime in 2002, three, and four,
Right.
where things spiked and all of a sudden nobody could afford their house. But man, from an affordability standpoint or just your budgeting standpoint, it helps you buy that house sooner rather than later. And yes, the one cool thing about this versus a permanent buy down, you know this, Brian, when you do a permanent buy down, let's say you pay 2 points to buy a note rate down a half point, which doesn't make anywhere near the difference in payment as this.
Right.
But it may make sense for you because you think you're going to be in the house a long time. You're generally, the break even is around 60 months, so 5 years.
Right. Yep.
Um, However, rates drop to 4.5% next year, you're going to refinance anyway. You've now wasted all that money up front,
Right.
and it's gone. The cool thing about the temporary buy down is all this money, they're literally this 17 grand goes into an escrow account held by the mortgage company, and then they just dip into it each month to make your payment whole to the investor, Fannie Mae, Freddie Mac. And so, however much money is left over, if you refinance in 9 months, There's probably of the 17 grand, there's probably over $10,000 left. And then you get that money back as the homeowner to utilize towards either your refinance cost or drops your principal balance. So you get full utilization of this, which makes a huge difference.
Well, and unlike an adjustable rate mortgage, your top end mortgage rate at that point is 6.5%. So, God forbid rates do go back up, that's still your highest point and you're still ahead of the lender. If it's I think the key here is that if rates go down, you have the opportunity to refinance again within that 2 to 5 year period. If rates do go into the five, even if it just goes into the fives, 5.25, 5.5,
That's right.
gives you the opportunity to redo that. But if the rates go up, the mortgage lender's still stuck with it, and you still got the benefit of that after the second year in the loan.
That's correct.
That's I'm blown away that more people aren't using that.
No, I think it's funny, man. When rates started spiking, we preached this like crazy, right? Like we were like
Right?
talking about this, and we had a few in 2022 that did this, but not nearly as many as you'd like to think. I think at that time, sellers were not ready to capitulate. They were not ready to drop
Yes.
their price or negotiate. At this point, if the house has been on the market for more than 30 days, this is absolutely a great tactic. Yeah, as a buyer, you may need to pay a little bit more than you want for the house, but if you're going to get this, it's going to make your payment so much more affordable, which is ultimately what you care about, right? I mean, you want to make sure you're not overpaying for a house, but if you're going to be in a house for 2 or 3 years or more, you're going to get your money back. I mean, unless barring some weird thing that causes a 2008, which is, literally only happened once since the Great Depression.
Right.
It's very unlikely, right? People continue to move to our area. We continue to be sought after. And so the values should continue to go up in our area. And this is a great way to help navigate, get into the home you want, have a reasonable, affordable payment, even though interest rates are higher right now, until you refinance in a year or two.
Gotcha. Very good. Michael, great information today. That was outstanding. For everybody watching, you can contact Michael. We'll leave all the information for his contact stuff in the body of the text down below. If you're on YouTube watching us, just check the information. Of course, if you like the video, click like, click subscribe, follow along for more real estate stuff. If you're on other platforms, make sure to follow us. And Michael, thank you so much. Again, Michael Martin, Martin Mortgage Group with Fairway Independent Mortgage
Corporation.
Corporation. Got it. So,
Thanks, Brian. I really
and when
appreciate it.
when you call him, ask about those 2-1 buy downs. And if your agent's not familiar with them, tell your agent to contact Michael and let's get you into house. Thanks everybody for watching. And I hope you have a great day.
Thanks, Brian.